$10 feels too small to change your life. It disappears in a snack, a delivery fee, or a subscription you forgot to cancel. But imagine investing that same $10 every day from age 25 to 65. At a hypothetical average return of 7% a year, it could grow to nearly $798,000. Yet you would personally contribute only $146,000. So where could the other $652,000 come from? And why do most people quit before their money begins doing the real work? Today, we will follow one ordinary $10 decision through 40 years. You will see the results after 1, 5, 10, 20, 30, and 40 years. You will discover when compounding appears to wake up, the hidden price of waiting, and 5 mistakes that can quietly destroy the plan. This is not a promise of easy wealth. It is the mathematics and psychology of giving small money enough time. Meet Daniel. He is 25, earns an ordinary salary, and has never considered himself an investor. $10 does not feel important. Some days it disappears on food delivery. Other days it buys something he forgets within a week. Daniel does not remove everything he enjoys. He creates one rule. Before $10 can disappear, it must first buy a small piece of his future. He automates $70 every week, about $304 per month, into a diversified long-term investment. After the first month, nothing exciting happens. After the first year, he is not rich. And this is where the real test begins. After 1 year, Daniel has contributed $3,650. His account might be worth around $3,769. Only about $119 is growth. After 5 years, he has contributed $18,250. His account might be worth about $21,776. Better, but still not life-changing. This is when many people assume investing is not working, but the system is not broken. It is building the part of the curve nobody finds exciting. In the beginning, Daniel does almost all the work. His money does very little. That relationship is about to change. Spending $10 today feels real. Investing it for decades can feel invisible, and we naturally think in straight lines. But when returns remain invested, future growth can begin earning additional growth. The base becomes larger. The next return is calculated on that larger base. Then the process repeats. At first, the change is difficult to notice. Later, the same process can become the largest force in the account. Investing the same amount at regular intervals is commonly called dollar cost averaging. It cannot guarantee a profit or prevent losses. Its behavioral power is that automation replaces hundreds of emotional decisions with one consistent rule. Daniel's advantage is not prediction, it is repetition. At age 35, after 10 years, Daniel has contributed $36,500. His account might be worth about $52,647. Around $16,000 may be investment growth, but Daniel has still done most of the work. That creates a dangerous illusion. The plan looks too slow. Yet the next 10 years do not behave like the first 10. At age 45, Daniel has contributed $73,000. His account might be worth approximately $158,449. Now more than $85,000 may be growth. Daniel's money has finally produced more than Daniel personally deposited. For 20 years, he built the machine. Now the machine is beginning to work harder. At age 55, Daniel has contributed $109,500. His account might be worth about $371,000. More than $261,000 may now be growth. But the biggest surprise is hidden inside the final decade. Between age 55 and 65, Daniel contributes only another $36,500. Yet his account could rise from about $371,000 to nearly $798,000. The final 10 years alone could add approximately $427,000. more than the entire account was worth after the first 30 years. The daily amount never changed. The account simply had more money and more time working together. Compounding rewards endurance far more than excitement. But the market does not deliver 7% in a smooth line every year. Some years can be positive, others can be negative. If Daniel earned no return, 40 years of $10 per day would equal $146,000. At a hypothetical 4% return, it could grow to around $360,000. At 7%, about $798,000. At 10%, roughly $1,924,000. That enormous range is why nobody can honestly guarantee the ending. These are mathematical illustrations, not predictions. The actual result depends on performance, fees, taxes, inflation, risk, and whether Daniel continues. Now imagine Daniel starts at 35 instead of 25. He still invests $10 every day and earns the same hypothetical 7% return. At 65, he might have around $371,000, not $798,000. He avoids only $36,500 in early contributions. But the ending balance could be lower by more than $427,000. He did not lose that money in a crash. He lost the years in which the early money could have compounded. Starting at 45 could produce around $158,000. Starting at 55 could produce only about $52,600. Starting late is not pointless, but you can earn more money later. You cannot purchase back a lost decade. So how can someone build this responsibly? First, protect the foundation. Keep accessible emergency savings. If you carry expensive credit card debt, paying it down may be more valuable than chasing an uncertain investment return. Trying to earn 7% while paying 18% interest is like running up an escalator moving downward. Second, match the investment to the goal. Money needed soon should not depend on an investment that can fall sharply at the wrong moment. Third, use an appropriate account available in your country and understand its taxes, fees, and withdrawal rules. Fourth, choose a diversified, reasonably priced investment that fits your timeline and ability to tolerate losses. Putting everything into one unproven company is not a system, it is a concentrated bet. Fifth, automate the contribution. Schedule $70 per week or about $304 per month shortly after payday. Then review the plan periodically instead of checking it every hour. When income rises, consider increasing the amount. $10 can be the starting level. It does not have to be the final level. Mistake 1. Treating 7% as guaranteed. It is not. Losses are possible, and the journey will not be smooth. Mistake 2. Confusing regular investing with safe investing. Consistency cannot rescue a dangerously concentrated or unsuitable investment. Mistake 3. Ignoring fees. In the same 40-year model, reducing the net return from 7% to 6% lowers the ending value from about $798,000 to roughly $606,000. That is a difference of approximately $193,000. A cost that looks tiny each year can become a massive lifetime leak. Mistake 4. Selling because the market becomes frightening. Panic selling after prices fall can lock in losses and may cause Daniel to miss a later recovery. The plan must fit his risk tolerance before the frightening period arrives. Mistake 5. Ignoring inflation, taxes, and purchasing power. $798,000 future dollars will not buy what the same amount buys today. The goal is not only to build a large-looking number, it is to build useful future purchasing power. Here is the plan. Choose one long-term financial goal. Check whether high-interest debt or a missing emergency fund should come first. Choose a diversified approach with fees you understand. Automate an amount you can maintain, then review it once a year and increase it when possible. If $10 is too much, begin smaller. If $10 is easy, Do not assume it must remain your limit. The best amount is not the one that looks impressive today. It is the amount you can continue long enough to become powerful. After 1 year, the result looked disappointing. After 5 years, it still looked ordinary. After 10 years, the growth became visible. After 20 years, the growth became larger than Daniel's contributions. After 30 years, the curve bent sharply upward. And after 40 years, $146,000 of contributions could potentially become nearly $798,000. Not because Daniel found a secret stock, not because he predicted every market crash, and not because $10 was magical. It happened because he gave ordinary money an extraordinary amount of time. The biggest advantage was not income. It was beginning before the result looked impressive and continuing while almost nobody was watching. Choose your number, $1, $5, or $10. Comment Day 1 below as a promise to your future self. Subscribe to Level Wise Finance for clear money systems without hype. And watch the 7 levels of financial safety. Next, because investing is powerful, but the right financial foundation must come first. More money alone will not fix your finances. A better system will.